Hello, I'm going to talk about a very important concept today, which is internal rates of return. Very important concept in financial management paper. But I can't explain IRR, internal rate of return, without revising what time value of money is with you. So I'm going to quickly touch on time value of money, then I will focus on the major concept for today, which is internal rate of return, IRR. And I'm making this a separate video because I know it's something a lot of students have been struggling with. I'm going to break it down so well that you will understand it and you'll be able to even teach someone. Right. So we would need this for cost of capital. We also need it in section D, investment appraiser. So it's a concept that is really very important, and I'm going to spend time today to deal with it. But let's quickly look at time value of money before I go into entire chapter. So I'm going to quickly talk about time value of money now. Yeah, time value of money. What is time value of money talking about? We are talking about the money you have now. How much does it worth in the future? So let's say you have $100 today. $100 today can buy you a good shirt. Yeah. But maybe after 5 years, if you keep that same $100 note, it's not going to buy you a good shirt again. Probably if you're lucky, it might get you a basic, but think about it. Maybe a pair of stockings, right? If you're lucky, just something. So the point we're making is time value of money is telling you that the money at hand today is worth much more than the money in the future. So which means if you're going to preserve the value of this $100 today, you need to invest it. So when you invest it, you're going to get return. And when you make return, you probably make something like maybe 120 in total. So you have $20 return. So with that, you might be able to still get a pair of shirt, a shirt and not just a pair of stockings. Yeah, after 5 years. So that's just an example of what time value of money is talking about. So what we're saying is that the money today is not the same as the same money in the future. Today is better than tomorrow, right? Because the money at hand is sure, but the money in the future is not the same. Because of what? Why? The major reason is inflation. And apart from that, there's element of risk and uncertainty. Imagine if you give this $100 to someone, that person might run away with $100. So you lose the money. Or even inflation, yeah, which is another reason why money will lose its value in the nearest future. So you want to be comfortable with this concept. And there is a formula I'm going to introduce, which is very important, and that is the future value and present value formula. And that is the formula that says the future value of any money equals to the present value of that money into bracket 1 plus. This R can be inflation rate, but usually we call it interest, but it's a rate. Raised to power n. N is the number of years. So FV is the future value. And PV is the present value. Yeah. R is the rate. Yeah. It can be your discount rate, or you call it interest rate. Yeah. And N is the tenor. Yeah. Number of years. Very important to know what those. So this same formula can actually be rearranged to what we now call the present value formula, which is the same formula I'm going to write. PV will now is same thing as equals to FV into bracket 1 plus R, but this time around minus N because we have rearranged it. So this is the future value formula, or you call it compounding formula, or you call it future value formula. And this one is called the present value formula. or we call it a discounting formula. So when you have money today and you take it to the future, you are compounding. When you have money in the future and you are bringing it back to today, you are discounting. And you must apply the appropriate formula as it is. So from future to present is discounting. From present to future is compounding. And compounding is the FV formula and discounting is the PV formula. Please take note. That's just to give you a bit of understanding. So if you compound $100 over 5 years at say 10%, that means the future value will be equals to 100 into bracket 1 plus 10% raised to power 5 because n is 5. And that will be equals to, if you use your formula, 1.1 raised to power 5. Okay, your calculator can quickly do that. That's 1.1 raised to power 5, then multiply by 100. And that gives you 161. So that's the future value of 100 in 5 years over at 10%. Right. So this future value, if you want to also determine the present value at 10% over 10 years, use the present value formula. That will be present value equals to 161 into bracket 1 plus 10% raised to power minus 5. And that same will give you a present value of 100. So that's how to use the present value formula and the future value formula. So here what we've done is that we've taken 100 to 161 over 5 years. Yeah, so this is future and this is now. And here what we have done is that we took 161 to present now. And 161 now what's 100. So 161 in 5 years is what 100 now. That is what we are saying. And that is how to look at present value and future value. So good. Now that is just a quick reminder on time value of money. Now let's go into the concept for today, which I want to spend better time on, and that is IRR. A very important concept, like I said. What is IRR? Yeah. IRR, general definition, and the most popular definition of IRR is rate. Yeah, say it's a rate that makes a net present value of an investment to be equals to 0. Very complicated definition. It's very easy for me to say this because I understood IRR perfectly, right, for so many years. But for someone that is just learning, I don't like this definition because I remember in my initial stage learning, I struggle with this a lot, and that is why I don't want you to struggle. I don't want you to go through that same stress that I faced. So that's why I'm going to break it down so well, right? Let's start from what is this used for before I break it down. IRR is used actually, yeah, to determine how profitable an investment might be. Please note that it's just to know how profitable. It's not like it's going to tell you the profit. So let me emphasize that IRR is not, I'll put not in capital letter, not an absolute measure of profitability. So that you don't get confused. So You will not use IRR to measure profitability, but you can use IRR to get an indication of profitability. So, and what do I mean by this? And I'm going to break it down gradually now. So, what is an absolute measure? First of all, if you invest 100 and over 2 years, well, let me not use 100. No, 100 is too common, so you don't get confused. I'll use just, let me say you invest $20 over 2 years. And after 2 years, you get $24. You are excited. What's your absolute profit? Your absolute profit is 4. 24 minus 20. And in terms of percentage, that is 4 over 20. And that is 20%. Right? That is your absolute profitability. But that is not IRR. If you want to get IRR for this, now let's start to break down this definition. This is the first definition I'm giving you. It says the rate, right, that makes a net present value of an investment to be zero. Yeah. This rate is not just any rate, but it's what? A discounting rate. So that is the first thing you need to know. IRR is a discounting rate. So it's not a return rate. Though we call internal rate of return, but it's a discounting rate. And how do you get it? It's a discounting rate. So discounting rate. So I'm calling this a discounting rate. Take note. Discount rate is DR. Yeah. That brings a present value of cash outflows, cash outflow at par, which means equal with the PV of cash inflows, which means PV of inflows equals to PV of outflows. Any discount rate that make this to happen is equals to IRR. That's what we're saying. So look at this example. $20 you invest now, but in 2 years it becomes 24. So 24 is the future value, which is inflow that we're going to get after 2 years. But we need to let go of this present value of 20, which is our outflow. So I need to give the bank $20. So outflow, and in 2 years, the bank will give me $24 inflow. Now, I want to give you a very simplified form of IRR, though there's a bit complicated formula, which is not really complicated, which I'm going to give you, which is what you would use in calculating IRR in FM. But you need to understand the concept first before we go into a difficult calculation. But it's not really difficult, right? But just a bit more complicated than this. But let's build it from simpler form to complicated form. Right. So now listen, $20 is your outflow. So outflow is $20. What is the present value of outflow? Because it's going out today now. So the present value will be the same. Yeah. So the PV of outflow will remain 20 because there is no time between when the money is going out and now. It's going out now anyway. So the PV of outflow will remain $20. But inflow will not come until 2 years' time. So inflow is equals to $24. But this will happen in the future. So which means this 24 is a future value. Now, our IRR definition says that it's a discounting rate that makes the present value of inflow to be equal to the present value of outflow. Now we already know the present value of outflow. So which means we now need to find a rate that will discount our future value into an amount that must be equals to 20. Because what we are looking for is to get a PV of inflow that will be the same as PV of outflow. So which means we must get PV of inflow to be equals to $20. But currently, the future value of inflow is $24. So we need to calculate what rate will make this happen. Any rate that makes that happen will be our IRR. So like I said, this is a simplified form. So we can easily just use the discounting rate to say, okay, yeah, future value is equals to $20. The present, sorry, $24. So the present value we are looking for is $20. That's what we want to arrive at, this present value. The future value we have it is $24. And we know N is also 5 years, but we don't know R. Now we can simply use just bullet cash flow, so it's easy. There are no cash flows happening after year 1, so it's just year 0 and year 2. So we can say PV equals to FV, so bracket 1 plus R raised to power N minus N, right? So which means it's easy. We can just use $20 equals to 24 into 1 plus R raised to power minus 5. Right? So that's 20 equals to 24 multiplied by 1 over 1 plus R raised to power 5. So if you rearrange this formula, you have 1 plus R raised to power 5 equals to 24 over 20. And if you divide 24 divided by 20, that should give you 1.2. So 1 plus R raised to power 5 equals to 1.2. So 1 plus R equals to 1.2 raised to power 1 over 5. That equals to 1.037. So 1 plus R equals to this. So this R equals to 3.7%. Yeah. So this is the rate that if you discount 24 over 5 years to today, now, it will, if you discount this 24 at 3.7%, you will have 20. So which means 3.7 will be our IRR, because 3.7% is the rate that will make the PV of 24 to be equals to PV of outflow, which we know is 20. So PV of 24 at 3.7% will be equals to 20. And in that case, if you do PV of outflow plus PV of inflow, it will be equals to 0, because that is what we call referred to as NPV. And it's not done there yet. I'm still on like I said, I want you to have a very good understanding of what we're talking about. What does this mean? If you want to invest, how does it work? You need to get funding. You get funding, then you do what? You invest. Then after investment, you get proceeds from investment. So what you have done was you have sourced for $20, you have invested it, and you got $24 after 5 years. Remember that this $20, like we said from our formula of asset equals to L plus E, is you either get it as a debt or as equity. But either way, it is not free. There is always a cost of capital. So either you are paying shareholders something on top of that as equity, or you are paying the debt holder. But let's just keep it simple. Let's say you borrowed it. So there's going to be an interest that you need to pay. If you borrow $20 at 3.7%, Now you'll see where we're going. Let's assume you borrow $20 at 3.7%. It means that you're going to pay interest of how much over 5 years? If you calculate this 3.7% every year, the total interest you will have paid will be $4. And in that case, you will have given out $20 initially and another $4 as interest, right? So, so eventually, this is interest payment, and you also need to pay back principal $20. So eventually, the $24 proceeds that you have made has gone back to the owner of the money. And for you, what have you made? Nothing. So what can you make out of this? The summary of this is that this is why I told you that IRR gives you an indication of profitability. Indication of profitability. It doesn't give absolute profitability. Because what this has told you now is that IRR, and pay attention to this, is your break-even cost of fund. IRR is your base break-even cost of fund or your break-even discount rate. And the best way I like to put it, you probably have not seen this in any text before, is that IRR is the maximum cost of capital of any sensible investment. Sensible in what way? In optimal way, in a profitable way. So for you to be profitable, yeah, for you to be profitable, your IRR must be greater than your cost of capital. If it is the same, you are at zero. If it is less than, you'll be at a loss. Because if you had borrowed money at less than 3.7%, you won't pay up to $4 interest over 5 years. And if you borrow at a rate that is more than 3.7%, then you'll be paying more than $4 as interest. But your proceed will remain $24. So which means your proceed will not be as much as the total fund you have to pay back, because you always have to pay back both the principal and interest. So note this. This is very important and very good if you can understand it the way I've put it. So I've defined IRR in different ways, almost like in 5 different ways. The first way I told you is that it is the rate that discounts all the future cash flows into zero. That is, the net present value of both the outflows and inflows comes to zero. That is IRR. It's also the rate that makes the PV of outflows to be equals to PV of inflows. That is IRR. It is a break-even discount rate or your break-even cost of capital or maximum cost of capital for an optimal investment. And that is why it's being used even in investment appraisal, which we're going to learn in section D in subsequent videos. Because if you're using IRR, your IRR must always be greater than your cost of capital. And I hope that is clear enough, yeah, in that way. Because by the time we get into deeper computation, I need you to be able to follow through and not struggle a lot. So let's just do another calculation on IRR, a bit more like what you'll see in an FM paper. Yeah. So remember what I said, if cost of debt, which is your cost of capital, if it is less than IRR, that is good investment. But if cost of debt, cost of capital is greater than IRR, then that is bad investment. So you can't do it. Don't do it. This you can do such investment. But don't borrow any money that is being given to you at a cost higher than the potential investment IRR that you are trying to do. So you always need to test the IRR of the investment and be sure that it's greater than the cost of the fund you are trying to get in order to do the investment. Very important. Let's do this calculation to end it. I have a 10% bond. It's a price of $105. Yeah, this bond is redeemable in 5 years at par. Remember, at par means $100. Please ignore tax. Let's keep it simple on this. Let's calculate IRR for this investment. If anybody is trying to invest in this bond, what is the IRR? Yeah, if you want to invest in the bond, you might not have the money, or even if you're using your money, there's cost of equity. Yeah, so if you're going to borrow the money, there'll be cost of bond. So let's get the IRR of this bond so that when you want to go out to borrow money to buy the bond, you will know whether the interest they are charging you on that money you want to borrow will make sense for this bond investment. So let's get the IRR for this bond. The starting point is you must learn how to plot your cash flow. So we'll start from the time when the cash flow happens, so that's year. Then we'll have the cash flow itself. So now is year 0. We have year 1, year 2, year 3, year 4, and lastly year 5. Right. So what are the cash flows that will happen? Year 0 is now. We're going to depart with 105, cost of the bond. Remember, this is the price of the bond. So we need to buy this bond. So 105 will go out of my pocket. But when 105 goes out of my pocket, this bond pays interest at 10% every year. And remember, the interest is always going to be calculated at par, not on the price. So 10% of 100 is 10. So every year I will get 10 interest on this bond. Even on year 5, redemption is in 5 years' time and at par. So I will get my $100 back. So plus the interest of $10, I'll get a total of 110. Right, year 5. Then the next thing is when you are calculating IRR, you have to do try and error twice before you apply the formula. Take notes and see the way we're doing it. So you're going to guess 2 rates. And when you guess the 2 rates, you apply the IRR formula, which I will give you, then you get the IRR. So let's guess the first rate to be 5%. So which means we need to get a discount factor at 5%. And don't get rattled by discount factor. Discount factor is just this part of this formula. If you look at the PV formula and I give you the discounting formula, let's quickly go back. Yeah, this is the discounting formula that I give you, right? This one. This part is what is called the discounting factor. So you don't have to do all the calculation. 1 plus r raised to the power minus n. So there's a present value table where you can check all of that. Let me quickly show you. The present value table. This is a present value table. This is what it looks like. You'll be given in exam. Yeah, and you can see 1, 2. These are 1, 2, 3, 4, 5, 6, 7. Those are the rates, interest rates, and on the column you can see the period. Those are the number of years. So if you are looking for discount factor at 1% over 1 year, that is 0.990. Yeah, the first one here, 0.990. And if you want to do 10% for 1 year, that is 0.909. Yeah, and you can test it. Yeah, 0.909, 1 year, 10%. Look at it. If you use this formula, R is the rate, so that will be 10%. So that's 1 plus 10%. And year is 1, so raised to the power minus 1. That is 1.1 raised to the power minus 1. That will give you 0.909. And that is what you have on the table here. Yeah. So instead of having to do all the calculation for this box, items in box, you should always use your present value table. It makes it faster. So that's what we're going to be using here now. So the discount factors will always come from the present value table. That makes it faster and easier for you. Now, what's the discount factor for now, year zero? Anytime you are calculating the present value at year zero, which means for now, the cash flow that is happening now, today, the discount factor will always be 1. Please take note, always 1, because the 105 that you are paying today is worth 105 today. What you are doing with the cash flow of 10 in year 1, year 2 is to find a factor that brings it to today's value. It is worth $10 in year 1. This is worth $10 in year 2, $10 in year 3, $10 in year 4, 110 in year 5. All of these, we need to know what would they worth now. So we need their present value. And to get their present value, we need the present value table to show us the discount factor. And that is what we are seeing on this table. You can see there is no n equals to 0 here, because when n is equals to 0, at any rate, the discount factor will be 1. So there's no need putting it on the table. So now, the discount factor that we need is 0.952 for year 1, 0.907 for year 2, 0.864 for year 3, and just like that. So I'm going to plug all that in as I just showed you now. So for year 1 at 5%, that's 0.952. The next one we saw was 907 and 864, then 823 and 0.784 was the last one. So the present value is now the cash flow multiplied by the discount factor. So for the first one, minus 105 multiplied by 1 is minus 105. So we need to multiply 10 by 0.952, and that will be 9.52. This is 9.07. Next one is 8.64, 8.23, and finally we do 0.784 multiplied by 110, we have 86.24. So the net present value, which is addition of both the outflow and all the inflows together, everything all together, let's add together, plus 8.23 plus 8.64 plus 9.07 plus 9.52 minus 105. That's 16.7. So this is NPV. So that's our first NPV that we have. Remember I said we need to, because we need to do guesswork twice. So we're going to guess another rate now, right? So which means we need a discount factor, say let's say at 10%, right? So then we'll get another PV for that. So that will be our second PV. Right. So the same way we check the discounting factor for 5%, we check for 10%. So for year zero, remember what I said. For year zero, it is always going to be 1 because it's now is now. Then you have 0.909 for year 1, 10%, 0.826, 0.751, 0.683, and 0.621. So the PV, this would be minus 105, 9.09. We're still going to multiply the cash flow by the discounting factor, right? 7.51, 6.83, then 0.621 times 110. That's the next one we have to do. That's 0.621 multiplied by 110, and that is 68.31. Then add everything together. Let's get the second NPV. So plus 6.83 plus 7.51 plus 8.26 plus 9.09 minus 105, and that gives us minus 5. So this is our second NPV. So we have two NPVs now. Now it's time to calculate IRR, because we've done trial and error twice with 5% and with 10%, and we've gotten those two NPV. So now what is IRR formula? IRR formula is this: equals to L plus big, don't get scared with the giant bracket, it's just a simple formula, NL minus NH. I will explain what each of these means. Multiply by H minus L, right? So this is IRR formula. And how do you use it? Very simple. L is just mean your lower rate. That's what it means. And you guess two rates. There's lower rate and there's higher rate. H is higher rate. So in what we did, our lower rate, we used 5% as the lower rate. Our higher rate is 10%. So you already know this, you know this, you know this. What does NL mean? NL is the net present value at lower rate. Yeah, which in our example, that's NPV at 5%, and that's our 16.7. And NH is the NPV at higher rate. And our example, that is minus 5. So it's just to apply the formula. So which means our IRR is done. That equals to 5% plus, put the giant formula, smaller one, NL is 16.7 over 16.7 minus 5. Then multiply by 10% minus 5%. That is it. Then with this, we get 5% plus 16.7 minus 5. That will turn to positive. So that's 21.7. So I can do 16.7 divided by 21.7 equals to 0.769. So let's say 0.77 multiplied by 5%. That equals to 5% plus 3.84%. And that equals to 8.85%. So this is IRR for that bond. So which means, what this means is that if you're going to borrow money or even use equity, the cost of equity or the cost of debt that you're going to be using must never be more than 8.585. In fact, in real sense, it should be not be up to 8.85, because I don't think you want to do a business that will not give you profit. We don't want to make loss, but why wasting time and just doing a business and getting zero profit? So your cost of debt must never be up to 8.85. And that's what IRR is telling you, is the maximum cost of capital, is a rate that makes your future value and your present value to be, and the present value of all the cash flows to be equals to zero. So the net present value of the addition of PV of outflows and inflows, everything, when you add them together, the discounting rate that makes them comes to zero is your IRR. That is IRR simplified for you. If you have any question, please put it in the comment. This is Tutor Star. Follow us on Instagram, on YouTube, subscribe, share the link, share the channel. The lectures are free. If you have any question, like I said, feel free, comment, put in your comment. And if you like the video, please show your love and just like it. On to the next video. Bye for now. Thank you, guys.